Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to a forward exchange contract for speculation only. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area on the right-hand side, including our journal entries and then our trial balance worksheets, of which we will have 2 years because the data will span 2 years. So we have our information on the left. We're going to have a forward exchange contract. It will be a little bit different than the forward exchange contracts we've seen in the past. You're going to want to take a look at it for that little change here that we have. We have the timeline on 10/1/X1 entered into a 180-day speculative forward contract. So it's a speculative contract. We're going to be focusing in simply on the forward exchange contract, but it'll be a little bit reversed than the ones we've seen in the past. And then on 12/31/X1 balance sheet date, we're going to have to readjust the adjusting entries as of the balance sheet date. And then on 4/1/X2, deliver francs and receive dollars to settle the forward contract. In other words, the forward contract at the end, we're going to be delivering francs and receiving dollars. So that's the thing that's going to be basically different here. So when we set up the forward contract, we're going to be basically using these two accounts with the little green dot next to them, or square rectangle, versus the yellow items. So we're going to have the dollars received from the broker is now going to be in dollars. And then we have the foreign currency payable to the exchange broker. We're going to pay in francs, as opposed to what we have seen in the past, which was foreign currency receivable, which would be in the foreign currency like francs, and then the dollars payable in dollars. So we can set it up either way. We've been focusing in on the other way for reasons, because that's often the case if you're going to use it like as a hedge of something else or something like that. But if you're just speculative, of course, you can set it up either way based on whatever speculation that you happen to be making. So that's going to be the thing that'll be a bit different here. We got the rates that are relative to the dates here that we will be using, and the amount will be for 5,000 francs related to the forward exchange contract. So let's first put this thing on the books. We're going to have the same kind of starting point where we will have a receivable and a payable. It's just that it's going to be a little bit different on the names of the accounts. We're going to say that the receivable now is going to be in dollars. So instead of using this other account, which we might name something like foreign currency receivable from the exchange broker, we're not going to be getting foreign currency. We're going to be getting dollars this time. So we're going to say this is going to be equal dollars from the exchange broker. And then the other side, instead of us saying dollars payable to the exchange broker, we're not paying dollars this time. We're getting paid we're not paying dollars. We're going to pay the foreign currency, the francs, the 5,000 francs. So if we put this on the books, we're going to value that 5,000 francs then at this point in time using the forward rate. So same process we've seen in the past here, in that we're taking that amount and times the forward rate rather than the spot rate, the forward rate speculating into the future to the point in time that this thing all will end, which is on 4/1/X2. So that at this point is 180 days later. If we were to do that calculation on the calculator, 5,000 francs times the forward spot rate, which is 0.74, is 3,700. So let's do that calculation here as well. We're going to say this will be equal to, we're going to pick up the 5,000 francs times the 0.74 times the 0.74. There's the debit. There is the credit. Let's go ahead and post this out. We have the dollars receivable up top. So we're going to make sure to pick up the dollars receivable here. And we're going to say that's going to be the 3,007. Now, I tried to put some of these other accounts here just so you can compare to these other accounts. We're not going to be using them, but we've seen these accounts in the past. If it was reversed, right? So we're using the dollars receivable versus the foreign currency receivable here. And then on the payable side, we're going to be using the foreign currency payable because we're going to be paying in foreign currency. And there we have that. Now note, that means that if I take my calculator as a ruler, this item here is the one that's going to be the same throughout this entire process. It's not going to change because it's in dollars now, right? So we're going to get paid in dollars at the end of this whole thing. 180 days later, we're going to get paid dollars. Nothing funny happening here. It is what it is. Easy to account for. Down here, this is the one that's going to change because we're going to make a payment in francs. We're paying that 5,000 francs at the end of this, which represents $3,700 due to this forward exchange rate at this point in time. That will then change. That's the speculation, or that's the varying factor within our speculation that we're doing here. So then on 12/31, if we say now it's 12/31, and we have to then do our balance sheet and our adjusting entries at the end of the time period at that time, then we're going to calculate this thing as of the end of the time period. So instead of adjusting the receivable, as we've seen in the past, that's going to be in dollars, we're going to be adjusting the payable here because we're going to be paying in francs. So we're going to take the 5,000 francs that we're going to be paying, and now we're at the new speculative rate, which is 0.78. So times 0.78, that's going to be 3,900 minus the 3,700. We have a $2,000 loss. Why is it a loss? Because before, it was 1 franc is worth $0.74, and now 1 franc is worth $0.78. The franc is worth more dollars. The franc has gotten stronger, and we're going to be paying in francs. And so we're paying in something that is now worth more than it was when we initially made the contract. And so that's not good. So we're going to say that's going to be a loss to us. So we're going to be a loss here. And then we're going to say the other side's going to go to the payable. And let's calculate it again. Let's do it this way. This is going to be equal to brackets of, taking the bigger of the two amounts here, the 0.78 minus the 0.74. So we have a positive number, closing the brackets, multiplying it times that 3,000 or 5,000 francs. There's the 200 on the debit and on the credit side. Let's move the old calculator and post this thing out. So we have a loss. The loss is going to be on down below. This is going to be equal to the $200 loss. Then we have the foreign currency payable. So the foreign currency payable is going to be here. I'm going to double click on it, go to the end of it, say plus, pick up that $200. That now brings it to that 3,900. That 3,900 is the 5,000 francs times the current forward rate of 0.78. There's the 3,900. I'll say now we're going to go on down to the next year, because now we're going to say this thing's all going to end, and that happens on 4/1. So what we're going to do is take our ending balances up top. Ending balance up top will now be our beginning balances down below. Then the retained earnings is going to represent basically all of equity, the whole equity section, which would include this. If I'm just going to say all of it is in there, and I should probably just simply call it equity. So it's all there. So now we have basically our post-closing trial balance for year 1, or our beginning trial balance. Nothing's in the temporary accounts at this point. All right. So then we're going to say that we have to revalue this thing again at 4/1 so that it's all revalued, and then we can close this whole thing out. So we're going to say, all right, well, at 4/1, we're not changing this dollar one because we're going to get dollars, or I don't have to do anything to that one. But this one, we got to change this again to the current rate. So we're going to say now 5,000 francs that we're going to pay is going to be times, and there's no forward rate. Why isn't there a forward rate? Because this was speculative towards this point in time, and now we're at that point in time. So there's no speculation because like it's now at this point. So it went 180 days, 90 days, and now it's like now. So all we have is the spot rate. So I'm going to take the 5,000 times the spot rate, 0.77. We get that 3,850. Taking that amount minus what's currently in there, 3,900. We get the $50 change, $50 change being a gain. Why is it a gain? Because last time we had 1 franc was worth $0.78. And now 1 franc's worth $0.77, so it's worth less dollars, the franc is, and the franc has declined in value then, and we're going to be paying in francs. So we're going to be paying in stuff that now isn't as worth as much as it was before, so that's going to be good to us, so it's going to be a gain. So we're going to say, all right, there's a gain, so that means the payable is going to go up. The other side's going to be a gain down here. Let's calculate it again. This is going to be equal brackets of the larger of the two numbers, the 0.78 minus the smaller of the two, the 0.77, closing the brackets, multiplying it times the 5,000. There's the debit 50. There's the credit on the 50. Let's go ahead and move the calculator so we could post this thing out. So we've got the payable up top. So we've got the payable is going to be equal to that debit of the $50. Then we've got the gain. The gain here is going to go on down below. So that's going to be on the income statement side of things. Equals the $50 on the credit side. We now have that 3,850 in the payable, which we know was calculated or can be calculated as the 5,000 times the current spot rate, 0.77, 3850, that's right. Okay. So we have that. Now what we're going to do is we can pay that thing off now. We could pay off this 3,850. But we're not actually paying it in dollars. We got to pay it in francs. So we're actually paying 5,000 francs, which currently represents us owing in terms of dollars 3,850. So we want to pay that thing off. Can't pay it in dollars. We need francs. But we know the current exchange rate is that spot rate of 0.77, so we'll spend some dollars, pick up some francs, use the francs then to pay off the payable that's in francs. So we're going to say, all right, then we're going to say that the foreign currency units that we're going to pick up, we want to pick up 5,000 units of francs, which we're going to value in US dollars, which happens to be, of course, that 3,850 using the current spot rate. And then we're going to say cash is going to be used to pick up those francs. So this is going to be equal to the 5,000 francs. That's how many francs we promised to pay, times the current spot rate is at 0.77. So there's that 3850. So 3850 is our dollars worth of 5,000 francs as of the current date, which happens to be at this point in time, if you check your watch, 41x2. All right, so then we're going to say the units over here have gone up by $3,850 worth of units. And then we're going to say the cash is going down. So now we have our francs on the book. This represents the $3,850 worth of the 5,000 francs that we're actually holding on to. This represents the $3,850 worth of the 5,000 francs that we owe. Let's take those actually 5,000 francs, pay off the payable. So we're going to say, all right, we're going to use those francs to pay off the payable like we said we were going to do. So we're going to debit the payable and we're going to credit the foreign currency, and it's going to be for that 3,850. We can calculate it again if we want because it's good times to do so. So it's the 5,000 times the 0.77, once again, 3,850 on the debit and credit side of things. Then we're going to say the payable is going to be over here. Something's in it. Going to double click on it, go to the end of it and say plus. Pick up that 3,850, bringing it on down to 0. Then we have the foreign currency up top. Something's in there. I'm going to double click on it, go to the end of it and say plus. Pick up that 3,850, bringing it on down to 0. Now, the other side of things is that the forward exchange contract said that they were just going to pay us the dollars. Nothing has changed here. This has been the same since the beginning, like up top when we put it on the books at the very beginning. It hasn't changed because it's in dollars. That was part of the contract. They're going to pay us a receivable. We put the receivable on the books in dollars. Didn't have to change anything with foreign currency because they're going to pay us in dollars. No problem. Nothing funny going on here. So we're going to say then cash is going to be going up by the dollars they're going to pay us. And then we're going to be picking up or reducing the receivable. The amount you can pick up multiple different places, whatever makes most sense for you. It's going to be that, 3,007. Where did that come from? Well, it came from this journal entry way up here. So maybe you want to post it there to remind you of that, or you can recalculate it. It was calculated as the 5,000 times the forward rate at the point in time that the contract started. And there's the 3,007. So there's our debit, there's our credit. Let's go ahead and post this out. Going on up to cash, double clicking on it, something's in it, plus 3,700. There's our cash. The other side going to the receivable. Here is the receivable. This is going to be equal to the credit of the 3,700, which will bring that down to 0. So the end of the day, this whole thing started. We've only been dealing with the forward contract. If we go up top, we had 100,000 in cash at the beginning, and all we've done is account for this forward contract, and now we have less. So we could see, okay, that it's a speculative thing, and it didn't. So the speculation didn't work as well as we would have thought, because we got less cash at the end of the day. But in any case, the foreign currency units are now back down to 0. So we've used the foreign currency units in order to pay off the forward contract. Then we have the dollars receivable from the exchange broker. We have now received those, so those have been received. And so those have been in cash now, of course. And then we have the foreign currency payable to the exchange broker has now been paid off. So that's going to be back on down to 0. Then we have the effect on basically the equity. The effect on the equity here being the effect on the income statement from the prior year for the loss that we recorded as the adjusting entry at that point in time, which then rolled into basically the equity section here. Then the current period, we had a gain in the current period that's going to be reflected here, but the net of the two is that $150,000 loss over the extent of the contract. So it wasn't a good speculation. So just to recap the major differences, just note that we used these two accounts here, and this forward contract. The dollar receivable exchange broker is in dollars, the receivable in dollars, the payable in the foreign currency. And you could set it up the other way, depending on how you're speculating what's going to happen in the future. And this, if you speculate this way, of course, then you're speculating and you're adjusting then the payable. The payable is going to be the item that we'll be adjusting. If you're then, or you can set up the other way, where we have the foreign currency receivable from the exchange broker being the item that will adjust, and then the dollars payable on the liability side being the item that will remain the same over the time period. And of course, if you have the foreign currency receivable, if you're getting paid in foreign currency in the future, what's your bet there? You're speculating that the foreign currency will get stronger because you're going to get paid in something that will be stronger. Whereas if you're set up your system of the forward contract so that the foreign currency payable to the exchange broker, you're paying in basically the foreign currency, then your speculation is that the foreign currency is going to get weaker.